You have got to know the following updates that just came out right before the Federal Reserve meeting coming up. Let's get right into them. Quick mention that this is an example of an alert that I just sent out on Friday. It is a $1.1 million short. I took out 500 contracts on the QQQ. It is up $500,000. That's over 48%. And folks, every single time I make a move, I send the alert in my Stocks and Psychology of Money program. Link down below. There's a coupon code expiring in 4 days. Check it out. No guarantees you're going to make money, and I don't encourage people to follow my trades. The reason I post all of my notifications is just to give you an idea of my personal sentiment in terms of which direction the market is going, and I could be totally wrong, especially on the short term. Sometimes it works, and hopefully it works out more often than it doesn't. Hey everyone, me Kevin here. So we urgently need to talk about the stock market because today has been a disastrous day. The indices have swung between -2% to -4%. And you know what happens when we cross certain thresholds, like 7%? We start hitting stock market circuit breakers. Yeah, the same kind of circuit breakers that we hit way back in March of 2020. And so folks, we gotta have a discussion. When all of a sudden Tesla's down 9% in a day, smaller stocks like NIO are down 13%, on Arrival was down at one point as much as 26% in one day on no news, we've got to talk about a really critical and urgent warning about the stock market. And it has to do with the big old bailout that everybody is expecting from the Federal Reserve. But before I talk about the Federal Reserve, it's important that we talk about none other than Joe Biden. See, Joe Biden today has made it very clear, once again, in very hawkish tweets, that he plans on dealing with inflation one way or another. Unfortunately, these messages have really become an empty threat because Joe Biden's way of dealing with inflation is bitching to Jerome Powell. I hate to say it, but that's pretty much all he can do, is call up Jerome Powell and try to pressure Jerome Powell to stop the madness. Now, technically, the Federal Reserve is not supposed to be influenced by politics. But let's be real, we all know there are shysters up there, okay? Look, inflation is a massive problem for Joe Biden. And I'm going to talk about the Federal Reserve and something critical that you need to know about the Federal Reserve bailout in just a moment, okay? Whether it's coming, when it's coming, all of that in just a moment, okay? First, you got to know that inflation is a massive problem for Joe Biden. Now, you might not care if it's a big problem for Joe Biden because maybe you don't like Joe Biden. But you got to know if it's a big problem for him, because you're paying more money at the pump, it's bad for him politically, which makes it really hard for Democrats to win in November. I expect them to lose in November. And it's more likely that we end up with a Republican president in 2024. But on top of this, think about this, folks. When you have inflation, these are some of the things to consider when you have inflation problems for Joe Biden. When you have inflation, you kill wage growth. See, every president wants to say, I created jobs. I did a great job creating jobs in America, and people make more money under my presidency. Every president wants to be able to say that. Unfortunately, according to the last report from the Bureau of Labor Statistics, we had 4.7% wage growth, which is good, until you factored in inflation. As soon as you factored in inflation, wages actually fell 2.4%. Now, sometimes this is a little hard to understand, so think about this relatively. Imagine somebody said, hey, I'm paying you $100 this year, and next year I'll pay you $104.70. That sounds great, right? Positive, you're making more money. But what if somebody then came to you and said, oh, wait, just kidding. We're not paying you $104.70. We're actually now only paying you $97.60. That's the same thing as a minus 2.4%. It's a massive issue, and it is a terrible problem for a president to have to deal with because, quite frankly, they're relatively powerless, especially when they have a slow-moving Congress that can't deal with chip shortages and bottlenecks faster. All they have is executive action and really trying to pester the Federal Reserve, who can really quickly run the reversing printers and try to vacuum up money in the economy. But now, wait a minute, folks. Why would the Federal Reserve continue to be hawkish if the stock market is falling? I mean, look, folks, the NASDAQ, according to finance.google.com, is down 15.19% year to date, and the S&P 500 is down 10.36%. Like, wait a minute. Would the Federal Reserve really dare continuing to tighten the market if the stock market is falling? Bad news. The answer is yes, because here's the reality. The Federal Reserve's job is not to bail out the stock market. The Federal Reserve has two really important jobs. Number one is maximum employment. And this is not 100% employment, it's just their degree of what they believe is full employment, what the economy can sustain, depending on the current levels of labor force participation. There's a limit to how much the Fed can really do here. The Federal Reserve believes they've already achieved number one. The second thing the Federal Reserve has to do is maintain stable prices. And that we have been failing at substantially. Inflation has been out of control. Gas prices are out of control. Food prices, meat prices are out of control. Used cars, rents, you name it, it's out of control. And the current measures of inflation that we use are really bad at actually determining how much, for example, rent inflation we have. And yet housing makes up 1/3 of how much inflation we actually report. So if housing inflation takes a 6-month delay to actually show up, it takes 6 months for rent increases to actually show up in inflation, we could continue to have pressures of inflation build for months going forward. Now, how do I know that the Federal Reserve does not give a crap about your stock prices? Because look at what they say right here. The Federal Reserve noted that asset valuations remained high, generally high, relative to historic norms, while equity prices, aka stock prices, continued to increase, supported by strong earnings expectations and high risk appetite. Okay? That is them saying very, very clearly that, hey, we think stock prices are high right now, and the stock prices aren't actually being supported by really good fundamentals. They're being supported by high earnings expectations and high risk appetite. So in other words, they're saying, hey, stock prices are high, not because businesses are doing better, but because people think that businesses will do better, but they're also speculating more on the belief that that's going to be true. But folks, it gets worse. Over here, what do you have? A few participants also cited a number of factors representing potential vulnerabilities to the financial system. Quote, these included elevated asset valuations prevailing widely across asset classes. So the Fed is telling you that stock prices are high based on people's expectations and not necessarily reality. The Fed's also telling you that stock prices are high because people are willing to take more risk, not because reality is better. Then the Fed is also telling us that a big vulnerability to the financial system is, quote, elevated asset valuations prevailing widely across asset classes. So in other words, the Fed's telling you very crystal clearly, our job is to deal with maximum employment, which we think we've done. Then we've got to deal with inflation, which we're failing at. And we got to make sure that we limit financial vulnerabilities in the system. If high risk and speculation and high asset prices are a vulnerability, and if dealing with inflation reduces asset prices, then dealing with inflation and dropping the stock market's prices is actually a good thing in the eyes of the Fed. Which I know this is insane to think about, because in March of 2020, Jerome Powell came to the rescue. He came to the rescue for a solid year, almost a year. It wasn't really until February of 2021 when we're all like, it's okay, stock market's starting to fall, but don't worry, Jay Powell's coming out to talk, and all of a sudden he started having a little bit of a hawkish tune, and all of a sudden the stock market dropped on that. Tech started selling off in February of 2021 because Jerome Powell all of a sudden was a little bit more hawkish. Yeah, we're seeing that now on steroids, and I expect it to continue to get worse. The Federal Reserve is not one to change its mind quickly. Look how long it took them to change their mind on inflation is transitory. Now, maybe you think, oh, but hey, if stock prices are going down, maybe that means inflation's no longer transitory, right? Wishful thinking. Wishful thinking. I am wishing that inflation will go down soon. I really hope inflation goes down soon. But listen to data that literally came out today. This data came out today, which is the day before the Federal Reserve's meeting for January starts. And then we'll hear what the results are of this meeting on Wednesday at 11 a.m. I'll, of course, be streaming it. Anyway, here's what was stated. Quote, the median expected year-ahead growth in everyday essential spending increased from 5.2% in August to 5.4% in December, its highest reading since the beginning of this series in August of 2015. The median expected growth in non-essential spending instead declined to 2.5% in December from 2.6% in August, while overall households expected a bigger increase in overall spending in the next 12 months. The average reported likelihood of making large purchases over the next 4 months decreased in December with respect to vacations, home repairs, home appliances, furniture, and vehicles. So Let me break that down. This is from the New York Federal Reserve, and it is a survey on consumer spending. This report is telling you that people are having to forego on non-essential spending. They're spending less money on non-essentials, aka crap, toys, TVs, computers, hooters, tutors, whatever. Vacations, home repairs, home appliances, furniture, vehicles, right? They're spending less money on that, and they're spending more money on essentials. When you spend more money on essentials, it means you're spending more money on food and energy costs and gas or rent. It means that inflation is up. So in other words, literally going into the Fed meeting, the Fed is getting hit in the face again. Worst reading since the readings began basically in late 2025 or late 2015. So not good. Now, this, in my opinion, makes it unlikely that the Federal Reserve is going to back down from their hawkishness that is expected to come on Wednesday. Now, there are varying degrees of hawkishness that we might see. One is that the Federal Reserve might actually just end the taper and hike rates in January. That would probably crash the market. Not that the Fed really cares, but I don't think the Fed is going to do that because the Fed has been pretty transparent on their course, and they're trying to complete the taper by March and then raise rates, which we expect rates to go up 0.25% in March. They could potentially come in with a double rate hike, which would make the market even more nervous by March. This is why you're seeing so much volatility in the stock market, is because we have these inflation fears. Biden can't do anything. Biden's yelling at the Fed to be hawkish. People think the Fed's going to come bail them out, but they're wrong because that's not the Federal Reserve's job. The Federal Reserve's job is not to bail them out. Then people think that, well, maybe earnings will bail us out. In other words, the good is priced in, and you know what? We're going to get even more good news, and then the stock market rally. But the problem with that is, if we have high expectations that earnings are going to bail us out, then those expectations might disappoint. And even if those earnings came in hot, they might just encourage the Federal Reserve to tighten more because it potentially implies more inflation. But based on what we're seeing with consumer mobility data, if we look at Google mobility data, even as recently as 3 days ago when their last report came out on the 21st, we're seeing declines in consumer mobility. I went to a breakfast place this morning, and the place was unusually empty. And now this could be seasonal. It could be because in January people tend to spend less money than they do in December. Maybe they're out of money, their credit card bills come due or whatever. Or it's a sign that people are pulling back because they're worried about a potential recessionary period coming forward. Now, I don't expect a recession. I'm not trying to FUD, that's it, recession is coming. That's a small case for me. I think there's a 20% chance of a deflationary recession and a 20% chance of a hyperinflation recession. I think the majority of the odds are in the middle, that we're going to get through this, it's going to be painful, inflation's going to inflect down, and when inflation inflects down, then the market can actually start rallying again. But until then, we don't actually have motivation for the market to rally. On top of this morning, on top of this bad news regarding Biden being a hawk on CPI, on inflation, and then this latest inflation data, and the fact that we know the Fed's not coming to bail us out, on top of that, what do you have? Well, you have Russia tensions going nutso. The fact that look, Joe Biden mentioned this morning that he's considering sending 5,000 troops to the Eastern European region and the Baltics. You've got the Swiss military already moving ships into the region above the Baltics and where St. Petersburg in Russia is. You've got 100,000 Russian troops on the border of the Ukraine. And you start realizing, we've got a little hotbed here. And now the embassy in Kiev in the Ukraine is saying, you know what, embassy folks, you should send your families home because we might be going into war here. That's not good. The market fell on that news this morning. But let me put this into perspective, okay? We had 2,000 troops left in Afghanistan. Biden is sending 5,000 to Eastern Europe to maybe help our NATO allies like Latvia along the border of Russia. Okay, Russia has 100,000 troops on the border of the Ukraine. Just to compare this, when Operation Iraqi Freedom happened, we had 82,000 troops invade Iraq. This is 100,000 troops on the border of Ukraine, and Putin is now suggesting that we might end up seeing a Germany versus Poland style blitzkrieg, which is like a 48-hour invasion and turnover and overthrow of power, kind of like the Taliban rolled into Afghanistan when Joe Biden pulled out the 2,000 troops that we have left. There are also fears about cyber attacks and fake us. Who knows? There's just a lot of drama and unknown that's going on. This is a big geopolitical tension. Combine this with inflation and the Federal Reserve. There's a lot of reason why the market is selling down. Now, I want to clarify a few things. First, I want to clarify that some folks have asked me, Kevin, why would you refinance properties to potentially buy the stock market dip? Well, let me make this very clear. You should only ever refinance properties if you can actually afford the additional payment. Refinancing properties is taking out, in my opinion, much safer debt than margin debt or credit lines because they have generally amortized terms. And if you don't know what amortization is, you shouldn't be touching this kind of debt anyway. And they're not callable like margin is. Again, if you're not familiar with margin calls, do not touch margin. I also want to make it crystal clear that I've never been margin called. So it's very, very critical that we remember that you want to stay away from margin, pay off debt, be careful. If you're a passive investor, buy the dip, man. Hodl and buy the dip. If you are a trader, like I am trading my portfolio, I think there is an opportunity to sell and rebuy lower. Maybe today is the bottom. Maybe, who knows? I do not know. But when I look at actually the positive catalysts that we have versus the negative catalysts that we have, I don't think it's over. Because I think Jerome Powell is not coming to our rescue. And I think that uncertainty is going to build over the next 36 hours before the Federal Reserve's meeting. And it wouldn't surprise me for us to see more of a sell-off again. The problem with every one of these rallies that we get is we get these rallies and then it enables other people to pile on the shorts or buy puts and then or just straight up sell out and then the market falls. It's simple psychology of money like I teach in the programs linked down below. Now, I want to be crystal clear. Please don't follow my trades. I do post every single trade I make in the programs on Building Your Wealth linked down below, whether I'm buying puts or closing puts. Just don't follow my trades because I can't guarantee that you are going to make money and I don't want to be responsible for you losing money. Anyway, thank you so much for watching this video. If you found it helpful, consider sharing it and we'll see you in the next one. Bye.